You bet your life in this week's edition of the Industry Leader Update. Putting your life on the line for a wager is not a pleasant thought, but it may be exactly what some American retirees are doing by delaying Social Security or getting a reverse mortgage. With the reports that show that 60% of American workers have less than $25,000 in savings outside of their home equity, it seems that there are two choices. When should I begin taking Social Security, and how long should I really wait before I get a reverse mortgage? Now, either way, postponing Social Security or a reverse mortgage may be a scenario where one is in fact betting on their life. It comes down to mortality. Now, Social Security does reward those who wait longer to take benefits because payments are based on life expectancy. The older you are, the fewer years you'll receive payments. But there is a dark side to this equation, and it's this. Those who do postpone Social Security payments may never see them, or even with higher payouts in the future, never realize what they lost by waiting. For example, someone that does postpone Social Security payments from age 63 to 70 would need to live at least to age 79 to recoup the money that they didn't collect during those years, even with higher monthly payouts. Or even worse, family history, genetics, current health, and the unexpected could see the retiree passing away before receiving one penny in benefits. It's something that must be considered, weighing the risk versus the reward of higher monthly payouts. Then there's betting your life to delay taking a reverse mortgage. Now, this issue presents itself for younger borrowers who may just qualify today, having large existing mortgage balances, and with today's home values and interest rates, and qualify. But let's say they decide to wait for higher home values, perhaps 4 years. Great, but even with a moderate recovery in the real estate market and a small increase in available proceeds for being 4 years older, higher interest rates could take it all away. In other words, with historically low interest rates today, potential borrowers should be aware of the risk of waiting it out, and that could ultimately disqualify them from getting a reverse mortgage. Just a small increase in interest rates could change the whole scenario. Now, every situation is unique, but as professionals, we must explain the risks of waiting, the risk of delaying Social Security payments or getting a reverse mortgage. If the client does have other assets to draw from, then perhaps they can tolerate such a risk. But if they are like the majority of workers that have less than $25,000 in savings, it seems the choices are clear. While medical technology has increased our life expectancies, we must also keep the unexpected in mind. Again, it comes down to the question, do you want to bet your life or secure your cash flow today? It seems our economy has pushed today's retiree into the position of making a big bet. Now, what are your thoughts? Please share your insights in the comments section below.